So again, I welcome you all the learners in this sessions, and we are going to discuss about the introduction of security markets. We have discussed about what do we mean by securities. Then we have the security markets, types of security markets, and various segments of security market. Now we are going to discuss about the functions of security markets. First one is the capital formation. As I told you how capital formation functions performed by security market. Basically, it is mobilize saving for investment in various sectors of the economy. So this way, they can play the role of capital formations. They mobilize savings for investment. Then we have the liquidity. It provides investors with an opportunity to sell their securities and convert them into cash. This way, the liquidity function is performed by the security markets to sell their security and convert them into cash. Now we have the price discovery. Helps determine the fair value of the securities through market forces. This way, the price discovery function is performed by the security markets because the price is determined with the help of market forces, and it provide or help the investor to determine the fair value of security through market forces. Then we have the risk management, how they perform this function of risk management. It offers financial instruments like derivatives for hedging against risk. So this way, they perform the function of risk management by providing various financial instruments like derivative for hedging and hedging against risk. Then we have the efficient allocation of resources, means it provides direct fund to the projects and companies with the best potential for growth. So this can be possible with the help of security market, that it provide funds to various projects based on social objective on any other objective, and also provide funds for companies with their best potential for growth. So these are the functions of security market. Then we have a term market indices. What does it mean? Basically, in nutshell, we can say it is measured performance of a section of the market. What does it mean? It measures the performance of a section of the market, that is known as the market indices. For example, S&P 500. This is performance indicator in case as far as US is concerned. In India, we have the Nifty 50, and in case of UK, we have the FTSE 100. So these are the basic measurement instrument of the performance of section of the market. So in India, you can heard about, or you have to know about the meaning of Nifty 50, how it works and how it measures the performance of any section of the market. What is the use of these market indices? Basically, it is used for the benchmarking, performance tracking, how a security is performed in the market, and also for passive investing. So on the basis of these measurement, investor decided whether to invest or not. In detail, if we can call, market indexes are a way to track the overall performance of particular segment of the financial market. Basically, it is a measurement instrument to track the overall performance or to measure the performance of particular segment of financial market, like a sector or the entire stock market. So this is clear definition about the market indices. Then we have they represent a group of stocks. Either they present a group of stock or a small group of stock or other security that are chosen to reflect the performance of that specific market area. This is another definition of market indices. Then we have by batching an index, investor can get a general sense of how a particular part of market is doing. Basically, it helps the investor to take the right decision of his or her investment. As far as the representation is concerned, a market index is essentially a basket. Basically, it is a basket of stocks or other security that represent a specific part of a market. So how it represent that? Basically, it is study represent the group of stocks. As I told you, that basket of stocks, in another term you can say, that represent a specific part of the market. And as far as the calculation is concerned, how we calculate, the index value is calculated based on the price of the underlying security in the basket. So what is the exact price or present price of underlying security in the basket? On the basis of that, they calculated the price. Then, as far as the purpose of market indices is concerned, basically indices are used to track, as I told you, to track market trends, compare performance when we are want to compare the performance one stocks with other. So these facilities provide a market indices, and it serves as a benchmark for investment strategies. Basically, it provides a benchmark because on the basis of measurement, investor decide to invest in any specific kind of securities. As far as type are concerned, market indices can be broad, like the S&P Standard and Poor 500, representing the US stock market, or focus on specific sector like the Nasdaq, which tracks technology stocks. So these are the various types of market indices. As far as the example is concerned, the Dow Jones Industrial Average DJIA is an index that tracks the performance of 30 major US companies. So this is another type of indices of US companies, that they measure the performance of 30 major US companies. Now, trading mechanism. You must know about what is the trading mechanism in security market. Order types. There are various type of order. Market order is there. Limit order is there. Stop loss order is there. We will discuss in detail. Settlement cycle. T plus 1 means within 1 day, and T plus 2 means within, it may be 1 or 2 days for a transaction or investing the money. And third one, we have the dematerialization and use of depositories. And then we have the high frequency trading and algorithm trading. So we will discuss in detail about these terms used in case of trading mechanism. Basically, as go discuss further about the trading mechanism, we must know about the meaning of trading mechanism. What does it mean? A trading mechanism basically is the process by which buy and sell orders are matched and executed in a financial market. So it is very clear definition of our trading mechanism, that basically it is a process where buy and sell orders are matched and executed in a financial market. It involves the rules and procedures that determine how participants interact, what actions they can take, and how buy and sell orders are matched to facilitate a transaction. So basically this is the main functions of any trading mechanism, where matching of buy and sell orders is there. Then we have the trading mechanism, the term which we used in the previous slides, that market orders. These are the types of order. An order to buy or sell a security at least available price, at least at the best available price, executed immediately, means there is no time gap. In this case, it process is executed immediately, and security at the best available price. This is known as the market order. Limit order. An order to buy or sell a security at a specific price, or better executed only if the market reaches the specified prices. Here there is a condition of limit order, means specify rate to buy or sell a security at a specific rate. Then we have the stop order. An order to buy or sell a security when the price reaches a specified triggered price. When price reaches a specified triggered price, which then becomes a market order. So this is known or covered under the category of stop order. Then we have the other order types. It includes stop, limit order, day orders, good bill, good till cancelled, GTC order, and more, each with specific instructions and duration. So these are about the trading mechanism, in which we discuss about the market order, limit order, stop order, and about the other type. Now the settlement cycles. Settlement cycle, basically it is a period between the date of trade is executed and the date the funds of security are transferred. Between the day trade, how the trade, when the trade is executed, that date is also required, and the date the funds or security are transferred. So this is about the settlement cycle. What is T2 trade plus 2 means? The standard settlement cycle in a market meaning the transaction is finalized 2 business days or after the trade date. So this 2 means when the transaction is finalized in 2 business days. And what is T plus 1 and T plus 0 mean faster settlement cycle for certain transactions where there is a requirement of faster settlement, then we use this settlement cycle of T plus 1 or T plus 0. Now again, two terms we have also discussed, that is dematerialization and use of depositories. What do we mean by dematerialization? The process of converting physical stock certificate into electronic records held at a security depository. Basically, here the process of converting physical stock, the stock which we have available physically, convert stock certificate into electronic record. Then we have securities depositories, means organizations that hold securities in a dematerialized form and facilitate their transparent settlement, that is known as the security depositories, where organizations hold the securities in a dematerialized form. High frequency trading, HFT, means, so these are very important terms in financial market, and these terminology one must know. A type of algorithm trading that utilizes sophisticated computer program where the entry of the program, sophisticated computer program is there to execute, basically to trades at extremely high speed, often within milliseconds. Then in that case we need the high frequency trading process. We require this process if we want to settle or execute trade at a extremely high speed, often within millisecond. Then this is very important, regulation and governance, how these security markets are regulated, is regulated, and who are the key regulators bodies. Basically the purpose of these regulation is to ensure fair, transparent and efficient markets. This is the basic objective or functions of any regulatory bodies, to ensure fair, transparent, efficient market. In USA we have the SEC, in India we have the SEBI, in UK we have the FCA. The role of disclosure, insider trading laws and protection of investors, these all are also covered under the category of main objective or basic objective of any regulatory bodies. In regulatory framework in India, when we are discussing about India, SEBI is there. SEBI regulates various intermediaries in the security markets, including merchant bankers, stock brokers, portfolio manager and registrar to issues. In addition to SEBI, other bodies other than SEBI, we have the Reserve Bank of India also plays role in regulating the securities market, particularly that the money market agreement. Now, what are the main objective of SEBI in case of regulation of security market? It protect, first one is it protect the investor interest, first one. Then it promote the development of security market is another objective. Then it also regulate the market for fairness and transparency. These two terms are very important, the fairness and transparency in any kind of transactions. Everybody wants fairness and transparency, so SEBI is a close watcher, you can say, in case of security market, and very close monitoring by them, and time to time they issue guideline and direction to the various trader exchange, various traders and various investors. Then we have the about security exchange in detail. SEBI basically promotes the development of sound and efficient security market through various initiatives, including encouraging new investment avenues and promoting market infrastructure. Apart from this, SEBI regulates all aspects of the security market, including stock exchanges. They also regulates in intermediaries, brokers, investment and visitor, and the issuance and trading of securities. SEBI has the power to investigate violation of regulation. If they find that there is a violation of regulation, then they can investigate, impose penalties to the defaulter and take corrective action to ensure compliance. In order to take compliance at right time, they also take corrective actions. Apart from SEBI, as you know, SEBI Act 1992, it came into existence. This act provides the statutory framework for SEBI purpose and functions. Then we have the Companies Act 2013. The act this act governs the issuance, allotment, and transfer of security by companies. This is the main role played by the Companies Act 2013. Then we have the Security Contract Regulation Act, XCRA 1956. This act regulates transaction security on stock exchange. What is the main role of the Security Contract Regulation Act? Basically, it regulates transactions in security on stock exchange. Then we have the Depositories Act 1996. This act regulates the operation of depository which hold security in electronic form. Those the nature of securities in electronic form, these are regulate under the Depository Act 1996. Now, as far as the major stock exchange in India is concerned, as you have, if you already heard about these stock exchanges, I am going to discuss in very brief that National Stock Exchange, we have NSE, largest and most advanced electronic exchange. Then apart from this, we have the Bombay Stock Exchange. It is the Asia's oldest stock exchange, known for its Sensex index. So other than, we have the Metropolitan Stock Exchange, MSC, another recognized stock exchange we have in India. So these are the three main stock exchange in India: NSC, BSC, and MSC. As far as the recent development in security market is concerned, we have the online trading platform. Introduction of digital trading and mobile apps are using more and more in case of security market. Then we have the increase in retail participations, more individual investing directly in the stock market. Introduction of new products, REITs, Retail Estate Investment Trusts, INVIT's Infrastructure Investment Trust. These are the new products introduced in the security markets. Then we have the ESG investing. Basically, it is focused on environmental. E stand for environmental, S for social, and G for governancing factors while making investment. Then we have the blockchain and tokenized securities. So in detail, I am going to discuss about the blockchain and tokenized securities. Blockchain, basically technology, allows for the creation of decentralized and transparent ledger to record transactions. Basically, it is relates with the transparent recording of transparent ledger and track assets. While tokenized securities represent ownership in traditional financial assets like stocks or real estate through digital tokens on a blockchain. So this is the basic difference. Why blockchain is required? A blockchain is a distributed, shared, and immutable digital ledger that record transaction and track assets. On the other hand, the tokenized securities concerned, tokenized securities represent ownership in real world assets like stocks, bond, or real estate. These securities are represented by digital tokens. So this is why this term is coined, that is tokenized securities. Tokenizations can make investment more accessible to a broader audience and facilitate easier online trading. This is the global security scenario. You can see major global markets. We have NYSE, Nasdaq, and LSE. And basically, it's the globalization of the security market. One can trade out across the border, and cross-border listing of security is there. This is about the global security market scenario. Now we have the benefits of investing in security markets. First one is it is provide potential for high returns compared to the traditional saving instrument. This is one kind of benefits from security market, that it has the potential of to earn high return, to provide high return. Then we have the diversification opportunity to manage investment risk is there. Ownership in business through equity investments is there, and liquidity means easy buying and selling of securities. So these are the facility or benefits of investing in security market. Now these are the risks associated with security market. First one is the market risk. What does it mean? Fluctuation in market price. Then we have the credit risk, risk of default by the issuer. If there is no chance to get back money from the issuer, then there is a credit risk. Then we have the liquidity risk. In what does it mean? It means difficulty in settling in selling security without price loss. This is another kind of risk associated with security markets. Then we have the regulatory risk. If there is any change in the laws and regulations that may affect investments, because time to time government change and amend the regulations, so it can create a problem, or you can say it can affect the investment. Now these are the recent trends: rise of ESG investing, as I told you, environment, social, and government; growth of ETPs, crypto, securities, and digital asset market; and use of AI and blockchain in trading. So this is brief about the ESG investing, also known as sustainable or social responsible investing. Is an approach that consider environmental, social, and governance factors. Then we have the growth ETFs. ETF means exchange traded fund. These are the investment funds that focus on stocks or asset expected to grow at a higher rate than the broader markets. So how it works, that it provide focus, basically the focus of the ETF is on expected to grow at a higher rate than the broader market. Now this is all about this about the introduction of security market. And in nutshell, we can say the security market basically it is a vital for a healthy economy, and it provides a platform. Basically it is a platform for company to raise funds and for investor to grow their wealth. So it provides a platform, a company, those who required money, and for investor to grow their wealth if they want to grow their wealth by way of return. And understanding its functioning, benefits, and risk is essential for anyone interested in financial investment. So this is about the security market. So I hope you enjoy all this lecture. As in this lecture, we discuss in detail about the meaning of security markets, various types of security market. Then we have the role and functions we already discussed. I'm very much sure that you will able to analyze the various segments of security market, and you will also analyze the recent development, risk associated with the security market, and you will also able to describe the benefits of investing in security market. So thank you very much and wish you a happy learning.